It's been a really interesting period for gold recently, climbing to $1,960 before reversing course sharply and heading back towards its post-summer lows. Now, the yellow metal has been largely driven by the movements that we've seen in the US dollar and also in US Treasury yields. Ever since the Democrats took those two seats in Georgia, there's been a lot more talk about the potential for a stimulus plan, which Joe Biden has proposed at around $1.9 trillion. And the impact that that's had on the markets has been more focused on US Treasury yields and the US dollar itself. US stock markets have been pretty flat, if I'm honest, in the aftermath of that, hanging on near those highs, but not really propelling higher. And it's because of what we've seen in the Treasury markets why that has been the case. Treasury yields on the 10-year going above 1% for the first time in many months. Now, this has been driven by the possibility of higher inflation on the back of this massive stimulus spending. Should Joe Biden manage to get that through the slimmest of majorities in the Senate. Now, what that means is that higher yields have seen the dollar being supported once again. Now, the dollar's been on a dreadful run since March, falling quite considerably over the course of that period of time. So I think we're seeing a combination of the dollar seeing a little bit of favor once again from those higher yields, and also maybe a bit of a short squeeze as well. Now, again, it's worth noting on the 10-year Treasury, yields above 1%, 1.1, 1.2% is nothing to fear, but the direction of travel and the pace of the move that we saw in the aftermath of that victory is the thing that's keeping investors on edge a little bit. We've still got memories of the taper tantrum back in 2013, I think it was, and I think there's the fears were just arising. There's been a lot of efforts from the Fed over the course of the last week or two to downplay these fears, talking about the no chance of seeing bond buying being cut in during the pandemic, and even after, in the short term, there's no chance of rate rises, and that the focus is still on fighting the pandemic and getting the economy roaring once again. So there's been a lot of effort on the Fed's part to do so, and that's limited the upside in the US Treasury yields, but it hasn't caused them to pull back in any significant way. So the dollar continues to be relatively well supported in the near term. So while gold did get to around those 1960 levels, the pullback has been largely driven by the moves that we've seen in the yields and the dollar. And where we find ourselves now is we've seen two tests of $1,800. Now, what makes this really interesting is the fact that we've seen two big tests and two big rejections. So that suggests this is a major zone of support as far as gold is concerned. 1760 below the post-summer lows, obviously standing out as considerable support as well. But adding to this level is the fact that we've got a 200 and 233 day moving average band. Now, that has proven to be a big support resistance zone over time, including quite recently, as well, as you can see on the chart. So this is a major area of support as far as gold is concerned. A break below here would suggest that we have seen a significant reversal in fortunes as far as this is concerned. A break of 1760, given the 61.8 fib rejection as well that we saw at 1960, again, would also be a very bearish confirmation signal as well. So this is a major area as far as this is concerned. It has bounced back to 1850. A move above 1900 may provide a little bit more comfort, but my concern as far as gold is concerned, not necessarily of a break below 1800, but limiting the upside, is the fact that the dollar continues to be broadly well supported, and the fact that yields remain elevated despite the Fed reassurances may mean that we are in for a slightly longer period of potential dollar strength, which could continue to weigh on gold. So some key levels to keep an eye out for here, and a break in 1960 would suggest we're back in bullish territory, and suggest a run towards 2000 maybe on the cards, but a break of 1800 could be extremely worrying.